The crash profit pattern. How the same investors made billions in 1929, 2008, and will again. Dark screen. A single ticker tape flickers in the silence. In the autumn of 1929, Joseph Kennedy stepped away from the roaring market and never looked back. 6 months later, the world broke. In the winter of 2008, a quiet hedge fund manager named Michael Burry collected $700 million while the global financial system burned around him. 2 crashes, 2 different centuries. The same small circle of men walked away vastly richer. And now, in the final months of 2025, the exact same choreography is unfolding again. This time, in slow motion, in plain sight, documented in SEC filings, shareholder letters, and options order flows that anyone can read if they know where to look. This is not conspiracy. This is pattern recognition at its coldest and most profitable. Throughout financial history, whenever asset prices detach from reality and euphoria becomes unanimous, a 4-act tragedy repeats with mechanical precision. Ordinary investors ride the wave to the top and then ride it all the way down, clutching their statements as lifelong savings evaporate. A far smaller group, never more than a few dozen individuals and institutions, executes the same 4 stages in perfect sequence and emerges on the other side wealthier than before the storm began. They do not cause the crash. They simply refuse to die in it. Stage 1 begins 12 to 18 months before the fall, the quiet exit. While the crowd is still applauding new all-time highs, the sophisticated begin converting paper profits into cash. Not because they possess a crystal ball with an exact date, but because every metric they trust, margin debt, price to earnings, market cap to GDP, screams that risk now dwarfs reward. In the summer of 1929, Joseph Kennedy had already made millions running stock pools, legal pump and dump schemes dressed in pinstripes. Yet by July, he was selling everything. The legend says a shoeshine boy offered him a stock tip, and Kennedy decided, when even the shoeshine boys are in, there is no one left to buy. The truth was more clinical. Margin debt had reached 90% of market value. A mere 10% decline would trigger forced liquidation across the entire country. Kennedy saw the avalanche forming. So did Bernard Baruch, the lone wolf of Wall Street who had survived the panic of 1907. By September 1929, both men were almost entirely in cash. The Dow peaked on September 3rd at 381. 7 weeks later, on Black Thursday, the avalanche arrived. Fast forward 79 years. Between 2005 and 2007, while television pundits celebrated a new era of permanent home price appreciation, Michael Burry and John Paulson were doing something that made their investors want to have them committed. They were paying millions of dollars a year in premiums for insurance on mortgage bonds that the rating agency still called AAA. Burry's own limited partners begged him to stop. Paulson had to lock up redemptions. Both men bled cash for 24 straight months while house prices kept rising. They understood stage 1. You exit the consensus trade long before the consensus realizes the trade is over. And now, in 2024, 2025, watch the same silent exodus. Warren Buffett sits on $325 billion in cash and short-term treasuries, the largest dry powder hoard in Berkshire Hathaway's 60-year history. In his 2024 shareholder letter, he wrote, almost apologetically, that he cannot find anything reasonably priced. Translation: everything is priced for perfection in a world that is anything but perfect. Jeff Bezos sold more than $13 billion of Amazon stock in Schedule 10B FIV negative, one planned, systematic, emotionless liquidation of the core position that made him the richest man alive. Mark Zuckerberg has unloaded billions of Meta shares even as the stock touched new highs. Jamie Dimon, the longest-serving CEO among big banks, sold JP Morgan stock for the first time in his tenure. Across corporate America, insider selling has reached levels last seen in the first 9 months of 2007. The Buffett indicated total U.S. stock market capitalization divided by GDP now stands at 185%. Buffett himself has repeatedly said that anything above 120% is playing with fire. At 185%, the building is already burning. Most people just haven't smelled the smoke yet. Stage 1 is not panic. It is disciplined, almost bored detachment while the music still plays. And stage 1, as of November 2025, is complete. The smart money is out. Low cello note. The screen shows empty order books, flickering red. Stage 2 is when the orchestra keeps playing, but a few musicians quietly buy fire insurance on the theater itself. 6 to 12 months before the crash, while volatility is still historically low and protection is dirt cheap, the same group that exited in stage 1 begins to pay premiums. They are not hoping for disaster. They are simply acknowledging that when disaster does arrive, the payout will dwarf years of boring premiums. In 1929, the instrument was blunt. Short stock borrowed from brokers. Joseph Kennedy and Bernard Baruch spent the late summer and early fall of 1929 establishing short lines in the same companies they had just sold. They paid borrowing fees every month while the Dow kept grinding higher. Then, on October 24th, Black Thursday arrived. By November 13th, the market was down almost 50%. Their short positions, built when almost no one believed a crash was possible, turned hundreds of thousands into millions overnight. In 2008, the instrument was more elegant: credit default swaps on subprime mortgage bonds. Michael Burry began buying in 2005. For 2 solid years, he paid roughly 2.4% annually on billions of notional exposure, while home prices rose another 30%. His investors screamed. One famously wrote, "You are turning my money into a charity for Goldman Sachs." John Paulson paid the same premiums month after month, while CNBC anchors mocked Dr. Doom. Then Bear Stearns blew up in March 2008. Lehman vaporized in September. The swaps that had cost them a few $100 million in total premiums paid out more than $20 billion combined. Now watch 2025. The cost of portfolio insurance has already begun its inexorable climb, but it is still, by historical standards, absurdly inexpensive. The CBOE put divided by call ratio has spent most of 2024 and 2025 above 1, sometimes spiking to 1.3 levels that, outside of brief panic moments, have only appeared immediately before major declines. Large denomination VIX call options bets that volatility will explode are being accumulated for expirations in June, September, and December 2025. The size of the trades, tens of millions in premium, rules out retail gamblers. These are institutions laying in supplies before the storm. Most telling of all, the price of credit default swaps on commercial mortgage-backed securities, CMBS, has risen 300–500% since 2021. Someone is paying those higher premiums. Someone who has looked at the $2, $1 trillion in commercial loans maturing in 2025, 2027, at office vacancy rates permanently stuck above 40% in every major city, at buildings financed at 3%, now facing refinancing at 8%. They have done the math and concluded that a wave of strategic defaults is not possible, it is inevitable. Even Bill Ackman, the loudest activist on earth, has begun speaking openly about 2020-style hedges on commercial real estate and regional banks. When Ackman talks publicly about protection, you may safely assume the position is already in place. Stage 2 is not loud. It is the quiet clicking of millions of dollars moving into options chains and swap tickets, while the crowd is still arguing about whether the Magnificent Seven can keep carrying the S&P forever. The premiums are being paid, the insurance is being bought, the theater is still full of happy people. But the exits now have armed guards holding policies instead of guns. A single heartbeat. The screen is almost black. Then the first red candle of a daily chart appears. Slow, deliberate, unstoppable. Stage 3 is the scalpel. 3 to 6 months before the final break, when the broad market still feels invincible, but the first cracks are visible only to those who know exactly where to look. The same players move from general insurance to precision strikes. They no longer bet against the market. Yeah, they bet against the sectors, the companies, the securities that will die first and hardest. In 2008, this was Michael Burry and John Paulson identifying the exact tranches of 2006-2007 subprime bonds originated in Las Vegas zip codes and Central Valley exurbs bonds stuffed with pick-or-pay, negative amortization loans that were already underwater before the ink dried. Paulson went further. He shorted the investment banks that owned hundreds of billions of those bonds. Bear Stearns, Lehman, Washington Mutual. Stocks still rated strong buy by every sell-side analyst on earth. When Bear Stearns went from $130 to $2 in 8 trading days, Paulson's funds collected billions on that single name alone. In 2025, the 2 condemned sectors are already illuminated in neon: commercial real estate and the regional banks that lent against it. Office towers in San Francisco, Manhattan, Chicago, and Los Angeles sit half empty forever. The mortgages on those towers were written at 3-4% when the Fed funds rate was 0. Those loans, $2.1 trillion of them, begin maturing in the second half of 2025 and throughout 2026. They cannot be refinanced at 7-9% because the cash flow no longer covers the new debt service. Owners are already handing back keys. Brookfield walked away from 2 downtown LA towers in 2024. Blackstone has begun quiet workouts on San Francisco properties. This is not distress. This is rational default. The lenders holding these mortgages are not the mega banks. They are the 4,000 regional and community banks across America whose loan books are 25-40% commercial real estate. We have already seen the dress rehearsal. Silicon Valley Bank, Signature, First Republic, New York Community Bank Corp, all teetered or died from the same combination of duration mismatch and CRE exposure. Short interest in the KBW Regional Banking Index is now at levels last seen in March 2008. Hedge funds have built concentrated positions in the exact banks with the highest office loan concentrations in the worst markets. The data is public. The 10 Qs spell it out. The outcome is arithmetic. Stage 3 is already locked and loaded. Stage 4 is the part almost no one has the stomach to imagine, let alone execute. It happens at maximum fear. When the S&P 500 is down 50-70%, when unemployment is surging past 12%, when regional banks are being seized on Friday nights and reopened under new names on Monday mornings, when every headline screams that this time is different, that capitalism itself has failed. That is the moment Warren Buffett's $325 billion leaves the sidelines. That is when Apollo, Blackstone, KKR, and Carlyle, sitting on more than $1 trillion in uncommitted dry powder, begin buying entire portfolios of distressed office buildings at 30 cents on the dollar. That is when the same men who shot at the bubble buy back the world at prices their grandchildren will never see again. In 1929, Joseph Kennedy bought real estate from ruined families for pennies and emerged a decade later as one of the richest men in America. In 2009, Warren Buffett extracted 10% preferred dividends plus warrants from a desperate Goldman Sachs while the building was literally on fire. In March 2020, Bill Ackman collected $2.6 billion on a $27 million hedge and immediately turned around and bought the exact stocks the panic had annihilated. Stage 4 is not greed. It is the cold recognition that panic is temporary and value is permanent. We are now in the final months of stage 3. The yield curve has uninverted every single time since 1950 that has happened. Recession has followed within months. Commercial loan delinquencies are rising exactly on schedule. Insider selling matches 1,000, 929, and 2,007 tick for tick. The Buffett indicator sits at 185% higher than 1,000, 929 higher than 2,000. The pattern does not care about your politics, your hope, or your belief in artificial intelligence as the new perpetual motion machine. It only asks one question. When the music stops, will you be holding a chair or holding cash and the courage to buy when blood is running in the streets? The 4 stages have played out twice in the last 100 years. They are playing out a 3rd time right now, in real time, in regulatory filings you can read tonight. The crash is not coming. It is already here quietly, methodically, inevitably. And when the final act arrives, a small handful of men and women will walk through the smoke carrying more wealth than they had when the fire started. The only question left is which side of history you will be on when the lights come back on. Screen fades to black. A single line appears. Maximum fear is maximum opportunity.